How's it, boys and girls? Welcome back to the channel. Thank you for tuning in. If you are new here or you are a returning member, please consider giving us a like, and um, if you haven't already, please subscribe to the channel. Okay, guys, so today's video, I want to make it very quick, but I have so much to share, yet I want to make it very quick. So I'm gonna show you. I'm gonna be talking about yesterday's price action. So today is Tuesday. Still the AMs of Tuesday. So I'll be reviewing yesterday being Monday. Monday's price action. So I did take a trade on Euro USD. I bought right there very close to the low, and then I exited right there very close to the high. This was actually the high of the day. As you can see, price still struggled to break that high. That tells you that you know there's a reason I exited there. It's because um, these markets, they are manipulated, so it's very easy to trade them if you know what you're doing. So on euro, two positions there, exit there. Pound, one position there, I added one more there, exit there, very close to the high again. So going into the business on euro 5 minute, I want to review the price action from when it opened at 12 midnight to when it closed at its closing time. So I'm gonna be reviewing everything. I'm gonna try my best to be as fast as I can. In fact, I'm gonna be fast. So I'm gonna try my best to be as slow as I can, rather. I think, yeah, because I can easily flow when I'm speaking about these things. So we open here at midnight. You wanna mark the opening price at midnight. I'm on a 5 minute, whatever time frame you're on. As long as you below a 15 minutes, you wanna mark the midnight opening price. You can extend that throughout the whole day, or you can make your job easy and extend it up to 11. Up to you. What that will do is that not only will you see price react to this opening price throughout the whole day, it will use it as some sort of dynamic support and resistance. When price is trading above it, it will use it as support. But when price trades below it, it will use it as some sort of, a resistance. Not resistance as in like it will struggle to trade above. No, but like look at the highs of these candles. The wicks. The wicks are being formed right on this. Once it trades above, look at the low of this, the tail of this candle is being formed right on the opening price. The tail of this candle is being formed right at the opening price. The tails of these candles formed. It's showing you that that is indeed the opening price that the algorithm will recognize. So price opens there. Okay, if we are bullish, of which we were even before price printed this candle, we're bullish. I spoke about this in my previous video. I just made it like an hour ago. If we are bullish and price opens here, the best buys that smart money will take are below this opening price. So we open here on the daily. Let's assume it's a daily candle. It will open here at 12 midnight. In other words, it will open here. It will trade below. It will trade below to form the low of the day. To form the low of the day, where smart money will buy that up to the high of the day. So price opens there. It goes up to go down to trade to this fair value gap. After rebalancing this fair value gap, price price takes out this low. Can you see this low? So price breaks that into it breaks this low. What that does, it induces retailers into thinking that is a break of structure. So they'll be selling that. While they're selling that, the opposite counterparty to those sales is smart money buying this fair value gap. They're buying this fair value gap. They're also buying the trading below this low because we're bullish. And then price is higher. It comes back. What is this? If we are bullish, that is a bullish order block. A bullish order block. You can see price trading. If it first breaks above the order block, leaving an imbalance there, and then it trades back to the order block. Where does it trade specifically? It trades to the midpoint of the order block. What is the midpoint of an order block? The midpoint of an order block is called the mean threshold. The midpoint of an order block is called the mean threshold. While the midpoint of any gap, be it a fair value gap, a real gap, a real liquidity void, or a wick is also a gap. Any gap, the midpoint of a gap is called consequent encouragement. So this 50% level there that you see price trading to, that's the consequent encouragement. This 50% level there that you see price trading to, 50% of this candle, that's the mean threshold. So you can see price finding discount at the mean threshold. Discount aka support. Price it finds support at the mean threshold. Look at the bodies. The bodies are closing above the mean threshold, which is a indication that price is bullish. It's in a buy program. It's a confirmation that price is in a buy program. We have a low that gets taken out. We have a swing high that gets taken out with displacement. Displacement means fair value gap. So what is that? That is a market structure shift. I do not recognize a break of structure. I don't know what that is. I do not recognize change of character. I don't know what nonsense that is. All I know is shift of market structure after liquidity has been taken. What is that? That is model 2022. I made a video on it. It's the ICT model 2022. It's the ICT 2022 mentorship. So price finds support at the mean threshold. It rallies high. Now, when you're looking at price, now we're looking at the New York session. So you open here, that's London. London ends. Oh, never mind. So this is still London. Wow. Okay, so price trades to this. Oh, so I'm confusing this leg with this leg. I'm confusing this leg for this leg. Funny how they look the same. Wow. That just confirms how price is structured. So this is still in London. In London, we find support at this mean threshold, and then we rally higher. We form this high there at 1430, and then we retrace. We have a deep retracement, deep into what? What is this? It's a bullish order block. Why? Because it's a red candle while we're in a buy program. What is the midpoint of a bullish order block? It's called the mean threshold, right there at the 50% level. So we have this deep retracement after forming a high at 430. We retrace deep into this mean threshold. But look at the bodies. None of the bodies are closing below main threshold. Can you notice that? Only the wicks are trading below main threshold. That is a small signature in price indicating that, or rather confirming that price is in a buy program. In fact, yeah, it does indicate that price is in a buy program. So during the New York, as you can see, I have 7 a.m. here marked for New York. We have New York again. That thinking that, if a session starts at 7 a.m., I'm gonna mark the opening price. So if I'm bullish, I wanna see price trade below the opening price. So we first open here at 7 a.m. We have some trading above the opening price. Am I interested? No. When do I get interested? When price trades below the opening price. Why? Because I'm bullish. Why? Because London was bullish. So we're expecting continuation during New York. You see how easy everything just falls into place. If London is bullish, anticipate continuations in New York. New York started at 7, so a continuation would mean that we would have to break this low, this short-term low that we form at 705. If the continuation will begin at 7 a.m. and we know that for a continuation we're expecting a buy, and we know that in order for the price to buy, it first has to open here, print the low of the candle and then print the high of the candle and then retrace into the close. So with that thinking in mind, 7 a.m., if we're anticipating continuation, we will open here, print the low of the candle, print the high of the candle, and then retrace into the close. It's like that. It's like that on every time frame. So if we want to be participants of the New York session, we are waiting for this. We're anticipating this short-term low formed in the early New York to be violated. We're gonna buy that. So when they break below this low, retailers are gonna be selling that because they'll see that as a break of structure. We will see that as a turtle soup or a liquidity grab, but we will actually be buying that. Now, I made a video on this. 1, 2, 3. 3 drives pattern. What is that? That is a typical smart money reversal. Price was delivering lower prices, delivering sell-side delivery. We check out this low, we form a low, a lower low, third lower low. What do we do after that? We start breaking high. We start pushing it higher, aiming for what? Buy-side liquidity. Not just any buy-side liquidity. More specifically, London session buy-side liquidity. So now we are trading in New York. We are targeting the previous session's buy-side. Or if we were looking at London session, we will target yesterday's low or yesterday's high. But now because we're looking at New York session, we are targeting what? Previous session, which is London session's high or London session's buy-side liquidity. So we see price pushing higher, taking out buy-side liquidity, and then it retraces. Now, how far can it retrace, or how low can it go during the retracement? This is during the New York kill zone, right? So my thinking during the New York kill zone is that we have a swing low that gets formed to make your life easy. 880. To make your life easy, I'm marking New York. So my New York moves from 7 I'm now using New York as 830. So to make your life easy, I'm looking at the swing high and the swing low formed in between 8:30 and 11 a.m. New York time. What does that mean? Well, that means that I am acknowledging that there is a New York session. 1. 2, I am saying that there should be some sort of a move in between 8:30 and 11 a.m. Now, the direction of the move on specific days, the direction of the move is not what is important to me. The direction of the move, whether it's going up or down, I couldn't care less. What I'm more interested about is I'm looking at the swing high and the swing low formed in between 8:30 and 11 a.m. Why? We have a swing low there. What time is it formed? 9:20. It's a swing low. We have a swing high there. What time is it formed? 9:50. Before this, do you see any displacement leg before 8:30? Do you see any displacement leg? So before 8:30 and after 5 a.m., do you see any displacement leg in any direction? No. It's just consolidation, up and down. It's just moving sideways. The real move started here, where it moved with displacement. You can see now they're moving it. They literally moving it. They're even leaving fair value gaps. What do? They come back, they fill these fair value gaps. Which fair value gap do they fill? Because this is also a fair value gap. There's 3 fair value gaps that are in price, where I'm looking at price right now. So this is the first one, of which obviously it's not the one we want to trade. This is the second one. I'm going to show you which one you want to trade. I'm going to show you why you want to trade that one even. This is the third one. So this is basically the first one, the second, the middle one, and then the third one, right? Now, this one, the first one, doesn't really get traded too. Why? It is a breakaway gap. We expect it to be left unfilled. Why is it a breakaway gap? To answer that question, what makes this a breakaway gap, I'm going to also try to answer it like this. To answer that first initial question, which fair value gap are you trading? Well, I'm going to introduce you. I'm not introducing you to this. I already made a video on this. In fact, the first video I made on this YouTube channel after I started learning this concept was an OTE video, optimal trade entry, where in between specific times during the New York kill zone or during at specific times during the New York kill zone, we are looking at the relationship between a swing low and a swing high formed. We are anticipating a retracement into 2 specific levels. The first level being the 0.62 level, and the second level being the 0.75 level. The third level obviously being the 0.79 level, but we do not expect price to trade. We do not expect price to typically trade to the 0.75 level, 0.79 level. Oh no, I made a huge mistake. Okay, I'm gonna repeat because I unfortunately made a comment on while I was deselecting 0.75 instead of selecting 0.70.5. I'm gonna start afresh. OTE. What is optimal trade entry? OTE, aka the optimal trade entry, is basically a comparison between the relationship between the swing low and the swing high being formed in the New York session. So in the heart of the New York session, we're looking at what movement do they give us? And after they give us that movement, we are looking at the relationship from the low there, the low of the swing low. This is a swing low, right? So from the swing low there to the swing high there. Oh God. Yeah. So from the swing low there to the swing high there, we're looking at price retracing into two specific levels: 0.62, 0.62. I don't need this, to be honest. 0.62, 0.70, and we don't expect price to trade to 0.79. As you can see, it didn't trade to 0.79. Traded to 0.62. Sniper entry at 0.70. That's how I get this sniper. How do you think I got that sniper? It's not random. These snipers there. That's how I got them. That's why I'm making the video for you, so you can get them every day. It's like this. On a 5-minute, price will create a swing low and a swing high in between the new kill zone. It will retrace into the 70 level. Stop loss below this low being anchored to, but trust me, you can even be aggressive and put your stop loss right below 79. Trust me, you won't trade to it. Now, what I prefer to do, in fact, what I prefer to do is I like to use the bodies. Remember how I always said the bodies tell the story, the wicks do the damage. So if you use the bodies from the lowest open or close to the highest open or close in the same swing high and swing low I was looking at. So I'm not changing anything there. From the swing low, I'm looking at the lowest close, open or close. From the swing low I was looking at to the highest open or close from the swing high I was looking at. Same thing. We just adjusted them a little bit, but it's more accurate, to be honest. And then we get what? A continuation. Now we have equalized. It easily ramps through them. Comes back again to take out this low. Breakout artist think is gonna sell. You see that as a break of structure, while that is just a turtle soup for the lunch macro. Yeah, wow, everything is just falling into place. That is just the turtle soup, and then price it pushes higher again. It does obviously come back. Remember how the daily candle forms? Just go back to this. Price will open here, low of the day, high of the day. Now this high of the day, assuming this is a daily candle, that high of the day is represented by this guy here. I like this one instead of this second one. I like this high, but then they're almost the same. In fact, it's fine, I'll use this high. I like this high, so that's the high of the day, like this one here. And then it retraces into the close. What does it do? It retraces into the close. It obviously closed there. I like to use short log as my close. Like, trust me, Forex pairs, they don't have a PM session. So I like to close at 2 o'clock so I can use the opening price at 2 o'clock as my closing price. I can anticipate if they're using the opening price at 2 o'clock in the Forex market as my closing price for the day. Or I can just wait an extra 1 hour and do the same thing. Anticipate the 3 o'clock candle being my close of the day. So we were looking at euro. This is a very long video, I'm so sorry, but I'm trying to cover as much complex stuff as I can, as easily as I can as well. So we were looking at euro Now I'm gonna look at pound, because remember what I said, they should move in the same direction. So it's the same thinking on all of them. Now I have a different approach. So now we're looking at the same euro and pound. Obviously now this is pound, but we're looking at the same thingy. Ooh, I almost showed you something that I'm not even allowed to show, especially public. So now I'm looking at pound. Same thing on pound. We open here 12. Anything on the left is highly private. You see, this one I'll never teach you. I'm telling you right now, live. I'll never teach you what these boxes mean. If you learn them on your own, bravo. So you open here at 12, bullish day. So what do we expect? We expect price to trade below the opening price at 12 a.m. So we can see price trading below the opening price. It forms an initial low of the day. Obviously, I'm gonna, trust me, if market was trading around here, I would anticipate this low formed at 235 to be as being the low of the day. Trust me, because look what time it gets violated. Way after London. Can you see that? Can you notice that this low, it only gets violated when? After London. So during London, if we have a low like this and I'm bullish, I will not anticipate it being taken out. But once London is done, then they can take it out and form a new low. Obviously, that means they'll form a new low at New York. So you see how these concepts work. If you do, so we have this initial low there. Buy side gets taken out. We form a high there at 14:55. Right at 5 a.m. we form a high. So that is my London session buy side liquidity. After forming this high, After forming this high, we attack these equal lows. You know, this look equal. That's two equal. These are equal lows. So price will seek that sell side liquidity. After price takes out the liquidity, now they are ready to what? To push it higher. But before they push it higher, what are they gonna do first? They're gonna accumulate it. It sounds random, like it sounds like something anyone would just say. Trust me, it does. It does. That's why I like to repeat these things, so that the few of you guys who are watching and taking notes, you may, take notes. After they take out sell side liquidity below these relatively equal lows, after they grab sell side liquidity below that, they are ready to push it higher. So they are ready to what? They are ready to attack buy side liquidity above this high. So how will they do that? They won't just, okay, we take out relatively equal lows, now we're gonna print one big green candle up. Cool. No, it doesn't work like that. It doesn't work like that. It is all algorithmic. Before they attack this high, they will first accumulate it. They will manipulate it, and they will distribute it. Power 3. Power 3. I'm teaching all these things for free right here on my YouTube channel. Right here on my YouTube channel. Accumulation. This is a consolidation. As you can see, price is trapped between this high and this low. Literally, price is not moving anywhere above this high and this low. Only up until there. Can you notice that? Price was not moving above this high or above this low. The only time price traded above this high or this low was there when price broke out or left this original consolidation. How do I know it left it? Look at the bodies. Look at this one here. It fails to print above it. Even here, it fails to print above it, especially using the bodies. But here, it clearly prints above. And then it leaves a bonus, it leaves a fair value gap. So it breaks out using a fair value gap, using all of the liquidity found in this candle. So what does it do? It comes back to this original consolidation. So it acknowledges that there was an original consolidation here. Why do you think this video is so long? Why do you think I started by speaking about Euro first? It's because I'm leaving this lesson right here at the end. This lesson right here. The only thing I'll never teach anyone is this. It's these boxes. I'll never tell anyone what they mean publicly. But as for ICT's personal trading model, I will show you to you, like I'm doing right now. I'm showing you the way ICT himself trades. This is how I personally come close to ICT. I'm inviting you to come as close as me to our mentor trading. Original consolidation, breaking above original consolidation, return back to original consolidation. It acknowledges that indeed there was an original consolidation. We left it, but now we are coming back to it one more time to acknowledge it, and then we are leaving. Where are we going? We are ready to take out this high. Why? Because we are bullish. Because we're bullish. London starts here at midnight, ends here at 5 a.m. Pretending that we do not see anything after 5 a.m. Was London bullish or bearish? London was bullish. It was clearly bullish. It formed what at some point used to be a potential low of the day. London was bullish. With that thinking in mind, we anticipate New York continuing that narrative that London was bullish. So what time does New York start? I told you for me it started at 7 a.m. but for you to make life easy, it started at 8:30. So we're comparing the relationship between the swing high and the swing low formed between 8:30 and 11 a.m. New York time. Swing low, what time is it formed? 9:50. Swing high, what time is it formed? 10 o'clock. Retrace 62.70. Using the wicks, look how it touches 62 and then runs away. So on this day, if you waited for 70, you missed on your trade. Why? Because pound likes to exaggerate. It likes to have exaggerated moves. It is like US 30 in comparison between Nasdaq, S&P 500 and US 30. GBP USD, it is the US 30 of Euro. I'm not gonna lie, I feel like I just said everything I said now. I said it too fast so that I can confuse you. But if you got me, you got me. If you got me, you got me. So GBP, what it does is that if Euro is bullish and GBP is obviously bullish, GBP will have the more aggressive move higher. Just like if Nasdaq is bearish, US 30 will have the more aggressive moves lower. So it will lead Nasdaq and S&P. you can study for yourself. So GBP and USDT, same WhatsApp group. I don't like to trade them. They're not my. I prefer the other ones before them. So I prefer Euro over GBP USD. I prefer Nasdaq and S&P 500. I don't even trade USDT, to be honest. I only look at it. That's how I prefer Nasdaq and the other one over it. Because why? They like to have exaggerated moves. And trust me, I don't want to be in a I don't want to be caught offside. So the reason I don't trade them a lot is because I don't want to be caught offside. So on the time when I'm caught offside, I don't want to be caught offside, and then now prices are exaggerating in the opposite direction that I chose. So that's why I like to stick to the ones that move slow, because they'll have the more, mature moves. So I try to show you OTE. I try to show you OTE. I try to show you return to original consolidation. I try to show you model 2022, sell side below this low gets taken out, swing high gets taken out with displacement, fair value gap gets traded back to. So I tried to teach you model 22. I tried to teach you some order block theory. This does not close candles. When price trades above those, that's a change in the state of delivery. Price was delivering sell side delivery at this point in time when it delivered these two consecutive candles. But immediately when price breaks above the opening price of the two consecutive candles, that is a change in the state of delivery. That is an order block. It is a bullish order block. It's a change in the state of delivery by definition. It's a bullish order block. So I try to teach you order block theory. When price comes back to rebalance the order block, smart money is buying that. That's exactly how I got that entry on pound. Yes, I think I got it there. 24743. Yeah, 24743 somewhere there. That's how I try to teach you so many things. I try to one shot, don't kill it, basically. I'm trying to teach you so many things in one little short video. Now, going back to the complicated stuff. So going back to ICT's personal trading model. Original consolidation, break above, return to original consolidation, break above, order block here, come back. That is the first stage, bullish order block accumulation. Smart money traders are accumulating there. After they have returned to original consolidation, now they're accumulating. Manipulation is accumulation. They were accumulating orders here. Manipulating visually can be seen by a consolidation. So they were accumulating orders. They manipulated them by taking out this low and just trading below the consolidation a bit using the wicks, but look at the bodies are still staying inside. So that is manipulation. Even when they were going down, they were trading down when they formed these order blocks, these red candles in a buy program. Those are bullish order blocks. Those were formed during the manipulation. After they have accumulated, now they are ready to what? Distribute. So they'll distribute, they'll push it higher, they'll see this as a return to original consolidation, they'll see this as a first stage bullish order block accumulation, they'll push it higher, they'll see this as a second stage bullish order block reaccumulation. So it's called reaccumulation. They are entering more, they are reaccumulating, they'll push it higher. Where are they pushing it higher to? They're targeting that high London session buy side liquidity. So that's second stage, reaccumulation. Boom, they exit. So all the smart money traders who bought this from the first smart money trader who bought here after price trades below this low. So the first one bought here, the second one buys there, the third one buys this 62, the third one buys there, the fourth one buys there, the fifth one buys there, the sixth guy buys there. Oh no, that's after we check in buy side. So the fifth guy, only 5 guys are in this trade, right? Where are they taking? Where are they targeting? They're targeting. Guys, I'm so tired. That's why now I'm biting over my words because look at the time. Yeah, I'm still making YouTube videos. I'm so tired. So now they're trading. They're targeting this high, this London session buy side. They're in buy positions. They're holding buys. So in order for them to exit these buys that they're holding, they need to sell to someone who's willing to buy at a higher price above this high. Who is willing to buy at a higher price? A breakout artist who's gonna see this as a break of structure. So when price trades above that high, or a retailer who's gonna see this as a break and retest. When it comes back to this high, they'll buy that and it will rip through their stop loss. Guys, this is an advanced lesson on ICT concepts because I'm putting all of them in one video. What is this? The highest open or low? The highest open or close? It's a rejection block. I'm going all out, guys. I'm telling you everything that comes to my mind at this point. Rejection block. We trade back to the rejection block. Break lower. Almost you close there. Can you see that? It's not a coincidence. High of the day. 12:05. 5 minutes late. On this day. On a normal day, it's on time. It's on time. 5 minutes late. Forms a high. Attempts to take it out, but it fails because that is a very strong high. What is this? Projected high of the day. Oh, it's itching me. I want to teach you this so bad, but I will not. But look at, never mind how I projected it. But look, take my word for it. Take my word. You don't have to, but take my word for it. Look how my estimated high of the day is right there. The actual high of the day, obviously with the first one there, did it actually trade above this high? It did not. How beautiful is that? You can see it failed to take out this high. This actual high of the day, I put that way before it even printed these candles. I think I put that even before it came back to this rejection block. I put this actual high of the day even when price was facing down. So I put this actual high of the day, I think when we're still around here at 12:40 somewhere there. But even after that, look how it did not take out this high of the day. It is not a coincidence. Not a coincidence. Not even close to being a coincidence. Not even close. Guys, please like and subscribe. You see, I'm asking you because wow. As you can see what time it is.